Just one moment. Okay. Yeah, how is everyone doing today? Good?
Very good.
Yep, doing great, thank you.
Outstanding.
Okay, so here is, so as you guys know, we have a YouTube channel, so make sure to join it if you haven't yet. So today, just one moment, sorry, just getting my bearings around here right now. So, okay. So we meet on, so this finance meets real estate. We usually meet, just one moment again. I'm making sure I have the recording, okay. Okay. Okay, so this is Finance Meets Real Estate. We meet here every Tuesday normally, 6:30 p.m. Eastern time. And we're also a YouTube channel, Finance Meets Real Estate on YouTube. So we have different guests every week. So this week we were, yes, so we were having a guest speak on market analysis, but he's actually not available. So actually I'm gonna cover up, and plus it happens to be one of my topics that I usually cover either way. So so that's good. So I have some new content for today. So we're going to touch on like interest rates, recession prospects. So I will give like my perspective, and I'm curious to hear like on your side as well. And then market downside risks. This is something that I cover under Realty Quant, under my company. So it's sort of an expertise, I would say, of mine. And yeah, so okay, so a little bit about myself. So I'm founder of Realty Quant. It's an investment and analytics company in the real estate industry. So bringing data-driven and quantitative techniques to the real estate industry. In my prior career, I'm a financial engineer. I studied financial engineering in New York City, and I used to trade interest rate and equity derivatives in finance. So that's part of like my sort of slight expertise on the interest rate and like stock market side, you can say, and then perhaps a little bit bigger expertise more recently on the real estate side, which is going to be the second part of today. And I've been on like over 50 podcasts, and I host like this event. So yeah, so two topics for today. So recession prospects and interest rates is the first part. So like I mentioned, that's going to be like lots of slides from like different, basically other people's charts, like really interesting charts that I was able to find, and like things that I found interesting in terms of like insights from the general like economy and market and like stock market and so forth. And the second part is real estate market downside risk, which is, like I mentioned, something that my company Realty Quant works on, or I work on in terms of yeah, producing metrics on downside risk. So disclaimer, it's not investment, official investment. It is investment advice, but it's not investment purchase advice, I guess. So that, yeah, so just starting with the interest rate topic. So as you guys know, and feel free to join anytime, by the way, with any questions, or put them on the chat as well. We usually do like relatively open formats. So as you guys know, like last month, there was the yield curve, like the treasury yield curve in finance inverted. And so, okay, that kind of prompted some people to be concerned, and many people, including myself, to be somewhat concerned about the recession in the economy, which recession meaning like 2 consecutive quarters of GDP slowdown. And so what was the inversion? Well, on 1st of April, I think it was the first, yeah, Friday. So that's roughly a screenshot of Bloomberg bond markets quote that I took. So it's so the two-year rate was like 5 basis points higher than the 5-year rate. So that's the inversion quote. Now there was an inversion back in 2019. That inversion was a bigger one, like more basis points, so to say. But still, you know, this is an inversion, and usually it's seen as a recessionary, like predictor of recession potentially in that. And at some point, actually, slightly later in the day, 2-year was actually higher than the 30-year rate. So that was actually also interesting. So that's what happened. So that's like some of the history, like a chart that I put for yield curve inversions and recessions. So that goes back to 1968. And it says kind of how many months it took for, how many months was the sort of, the different gaps between the like timing gaps between events. And so, okay, so generally like yield curve inversion generally preceded recessions. An exception was Russian debt crisis in 98 when a recession didn't fall. But generally it's been a strong predictor. And in some articles, it's like 2/3. I'm not sure how they compute the probability, but it's like 2/3 probability of a recession within 12 months, 98% probability within 24 months. So that's kind of the general tendency. But of course, it doesn't mean that the recession is going to be a big one or a long lasting one and so forth. So, but generally, this is kind of like some of the expectation there. And the second signal, like a second relatively strong signal from the market is consumer confidence. So this is a chart a little bit less history. So starting around 83, 84, yield curve consumer confidence in recession. So it's the yield curve dips down, yield curve, spread of 2-year to 10-year treasury dips down into the negative territory, and or consumer confidence dips down. That is a signal, signal for recession, as some of you know. So that's like another supporting factor besides yield curve this time around. And here is actually the bigger history chart. Again, like in gray, you can see like gray is like are all the recessions, and you can see then the yield curve and the yield curve and consumer confidence in blue and gray, in blue and green respectively. So yeah, so generally both like relatively strong signals of a recession. Yield curve like considered an extremely strong signal. And so right, but that said, if we take an example from history, now that's precisely the example when a recession also didn't fall, like the Russian debt crisis. But okay, there was a stock market decline after the yield curve inversion in the chart. But okay, stock market subsequently continues to boom. So it's just like kind of a bigger picture consideration that continues to boom, but then later crashed like a few years later, more significantly after a significant expansion though. And so it's kind of hard to, it doesn't mean like a dooming kind of scenario. It's just like something that statistically does predict a recession, but it may not be extremely significant either. So that, okay, so just like a quick comment on like interest rates and recessions, because many people are concerned, I know now, including myself, okay, about rising interest rates. So they do tend to rise like ahead of recessions, but they do tend to heavily plummet and basically dip in once we're already in a recession. And so here is the history of like the 10-year treasury and like its significant dips in every recession marked in gray. So yeah, and again, like just as clarification, like I'm starting like some of the general market stuff from, basically charts that are not mine, but in the second part, we're going to transition to like fully real estate and basically my own content. But this is kind of like some signals from the bond and stock market. Okay, and then, so this is another very good chart. So actually, Fannie Mae had an amazing article about like different like recessionary signals. And so this is like a really good chart that they have on inflation, the interest rates corridor, the effective Fed funds rate, and also recessions that followed. And so usually like a very kind of like really high inflation, well above target, usually was followed by kind of a harsher downturn. And there are some cases here marked in green, which are kind of soft landings, as they call it, and they didn't fall, like such harsher downturn didn't fall. But one thing, the reason why I put this chart is if you look at, if you look in the 70s, for example, there was super high inflation. And so the argument of interest rates not severely going down in a big bond rally once we're in a recession due to having an inflation doesn't seem to hold, because both interest rates and inflation do plummet, or did plummet at least historically in recessions. And that's kind of what this chart is showing. And yeah, and also, kind of does show like the general, as most of you I'm sure expect, like general correlation between interest rates and inflation. But essentially, this kind of an argument against, okay, if we're having a stagflation, sort of inflation plus interest rates, are we inflation plus recession? Are we going to have interest rates continue to rise or something, and perhaps this time accidentally not dip, not go down, but generally they did go down when we had a high inflation environment as well. So that's why I think that's a great chart. And so here's another, so this is just like historical inflation and interest rates. So that is what is prompting a lot of people's concern about interest rates now. So as you can see at the end, the gap between current monetary policy. I mean, there's of course announced forward monetary policy, part of it reflected in the market, but kind of current monetary policy and inflation is like pretty high. So okay, so that's driving like some of the the rate hike expectations. And then in Europe, there is a significant mismatch between monetary policy and inflation, and you can see it in this chart. So a huge gap between the two. Yeah, so that's as a result of like kind of like tying like inflation and monetary policy together. Okay, so this is the current most expected rate hike path as of, I believe, around 10 days ago. So this was like right before the 4th of May 50 basis points hike. So this is what the futures market is pricing in. So futures market is kind of pricing. So at that point, 325 basis points of rate hikes, but again, like coming to the coming to the previous recession. So interest rates rise, and typically there are rate hikes ahead of a recession, but then the moment the economy crashes, perhaps, then they stop. So it's only until it works, and so then they stop, and then typically it's followed by a bond rally. So just kind of as a comment on that. But this is the current like projected path of I don't want to say interest rates, but like the Fed, the Fed rate, because yeah, so other interest rates do follow that, but it's not precisely, right? So okay, yeah, and then like this another chart, and actually just to give a perspective. So like here, like I mentioned, I'm starting with charts by other people that are not myself, and so you guys know I usually do my own content, and it's not like so common to do to kind of just keep quoting other people. But okay, but these were like some really amazing charts by Charles Henry Monshaw. He's one guy who I follow on LinkedIn. Make sure to follow him, has like really cool stuff, and Valerie Noel. And so, okay, so this is like interest rates and economic events. So again, like the discussion of, I feel like many people now being concerned with like the super rising, for example, mortgage rates as a result of, as a result of 10-year treasury rate rising. Is that one reflective the rate hikes of the Fed? But okay, this is like historically how like different increases in interest rates were followed by economic events such as global financial crisis and others, and sort of the respective rally in bonds and like declining interest rates that followed. And so okay, yeah, so where's the 10-year treasury now? Or that was like several days ago.
Excuse me.
Yeah. Go ahead. Okay. Yeah, maybe if you can ask your question also in a bit. But yeah, so this is like just, okay, this is like where the interest rates are now versus 2018. And so I just want to mention that, so I was a trader in finance, like or portfolio manager in finance, so in 2018 and 19 and 20. And so, and I was trading interest rates derivatives at the time. And I just want to mention that, okay, in 2018, I don't want to say it's the same situation as now, as it's not, there's significant inflation now and so forth, but the general, at least my sense, and this is just my personal view for interest rates is, okay, the Fed keeps hiking rates, like 2019, Fed keeps hiking rates, to kind of, keep the economy together or strengthen the economy. But then an inversion happened in 2019, and then it followed a bond rally. So bond rallies and interest rates dropping as bond prices increase. That's kind of in finance, the dynamic interest rates decline, right? And so then, the moment, at least at my job, we knew that we were in a recession code that was not measured yet. Was okay in late January and February of 2020, when the bond market was actually rallying in a massive way. And so you can see in the chart, so around February 2020, so you can see beginning of 2020, a huge plummeting of interest rates. And so this is like kind of my thesis on some of the current mortgage rates concerns. But of course, as we saw from the rate hikes before, the rate hikes that are currently priced in are also substantial. So it's just a question of, okay, how far do we go until the economy maybe a little bit collapses or sort of enters a recession? And then if it does, then some kind of sharp dip ought to happen, or at least historically it happened, as also by, seen like in this chart that I showed, like historically in terms of inflation in interest rates. So, okay, so that's kind of like where we are, but just to see that the 10-year rate, I think just recently reached like the 2018 level. And so the 10-year rate is what drives mortgage rates. So 10-year rate, so mortgage rates on the 30-year fixed mortgage, for example. So mortgage rates, typically people don't hold their mortgages for 30 years, and 10 years is like a very, big interest rate in the economy. And so generally mortgage rates correlate highest with the 10-year rate. And so, yes, so that's kind of the 10 years rising with, in response to the rate hikes is what's been causing mortgage rates to rise, as, I'm sure some of you know. And so, but another thing I wanted to mention, again, since I did mention like in 2019 and 20, what was actually the biggest recession, I don't want to say signal, but sort of almost confirmation that it's already there, which was like the huge bond rally. So stock market even was just like responding right after this, but that was kind of like the initial indicator. The second indicator or interesting thing that happened in 2020 recession, or very short-lived recession, that I experienced back then was, okay, the very high VIX. So VIX is the volatility index in the stock market. Now the volatility, VIX is very interesting actually, because, okay, so you can see that VIX with its measurement methodology, whoever defined, it was very high before the global financial crisis as well. But the daily, the daily movements in the market, because VIX is based on implied volatility, and not to go like too much in that direction since we are a real estate event, but implied volatility is derived from options in the market, and it's not the same as realized volatility. And so, okay, but what we did experience this time in 2020 was like huge realized volatility in the market during the COVID, let's say recession, COVID. And so, that huge realized volatility was pretty unique, because we saw like 9% moves in the stock market and so forth. And so at my then employer, we had volatility control funds. So volatility control funds are funds that they don't optimize returns. They don't try to have the highest return. They try to have the highest risk-adjusted return. So volatility-adjusted return. So those volatility control funds, they tend to kind of dump a lot of equities as volatility reaches certain triggers and levels, and in an automated manner. And so what seemed very different in the 2020 recession, like stock market dip that happened then, versus global financial crisis, we were seeing every day like this kind of 9% drops, and in the stock market, or not, certain days meaning, or very huge drops that were not seen during global financial crisis actually of this magnitude. And so the reason for that was volatility control, or seemed to be. And the moment, since like, so my employer was actually a fairly big, chunk in the market, like around 1.5% of S&P 500 trading volume, and around 7% of the second index, Russell 2000. And so the moment we reached like to like 54%, like dumped almost half of our equities and reached like 54% of our initial equities code. That was already, sort of, and then sort of our minimum level of like de-equitization as a result of volatility control, basically 1.5 days after VIX dipped and went down heavily. And so that was, so it seems to be like some coinciding with other market participants in the same way, in terms of sort of de-equitizing as much as they could. They cannot already do more. And so all volatility in the market disappeared. But then the question, that the argument here for this as we discussed, like some of the yield curve triggers and so forth. The argument here being if VIX is, if the market in 2022 does not have a different structure than 2020, presumably, where the 2020 structure of the market in terms of that volatility control, for example, was different than global financial crisis, then okay, in 2022, we have not reached such time yet. Because we're seeing, okay, like 3%, 3.5% moves in the market now and so forth. But VIX, this is as of today, is at 31 or so, and it hasn't reached, that high levels. So this is something to look out for as signals from the stock market. Then some economic indicators. So that again, I picked from Charles-Henri Monchot. So that's so bearish signals. So we mentioned the yield curve, to some extent the Fed policy, inflation, consumer sentiment we mentioned as well as bearish signals, and then bullish signals are, well, jobless claims are at a historical low, employment gains are strong, household savings are also strong, corporate earnings for the time being still relatively strong, credit spreads, etc. So those are like kind of a bit different signals in the market. And then another can say like maybe consideration or concern is, and we're going to get soon like to the real estate part, is, well, there is asset price inflation, then there's real economy inflation, call it. And so this is a chart, kind of, or a bar chart, like showing some of the discrepancy in asset prices versus real economy prices. And so that can be some kind of argument for, for potential asset overvaluation, but it needs to be computed in a much more precise way to actually know if it's there. But this is kind of like an interesting chart. Okay, then another thing that ties to the interest rate discussion, another, if you will, signal from the market is, so the tech in recent days has been showing a weakness. So tech, big tech tends to correlate with central bank liquidity, or like central bank's balance sheet and so forth. So this is a chart of central bank liquidity and the market capitalization of big tech. So companies like Apple, Amazon, Facebook, Google, Microsoft, Netflix, Tesla, basically. And so this is like in the chart, the forecast for central bank liquidity, and then respectively the, sort of a bearish, signal for those tech stocks, if you will. And that's perhaps part of what, the market seems to be responding to now, and there's like further discussion. Then another interesting thing, again, like just touching on like signals from the market before moving on to real estate. Another interesting thing is in times of high inflation, such as the 70s. So in the 70s, growth stocks, there can be, let's say, defined some kind of like technology stocks, for example, or like stocks that have like high price earnings ratios. They tend to perform very poorly. So that's actually interesting because we saw like the tech sector extremely boom, but you can see in the 70s, in the times of highest inflation, how the most expensive high price earning stocks perform versus the cheapest, call it, low price earning stocks. So that's another interesting thing. So, so tech does not respond very well to inflation, it seems. And so here is another like chart, again, through like Valerie Noel. So that's technology stocks and interest rates. So this is like the NASDAQ, and this is the inverse of the 10-year real interest rate. And so this is kind of showing like some of the correlation of the two in a way. So the technology sector broadly does respond to bigger changes in interest rates. So that's kind of what this chart is showing. And here's another chart just showing the current like the current dip in the NASDAQ since the very big spike in interest rates that we saw. So again, those are some signals from the market, just like recapping a little bit, like with the yield curve inversion, the general interest rates tendency in the recession, technology stocks, and some of like the inflation effects, and that at least that I was able to gather. And let me know if you guys have other comments on your side, and I'm sure we have some finance people here as well. But this is, these are like some things that I gathered. And another very interesting thing is, okay, if the technology sector is showing weakness, perhaps this weakness starts somewhere first. And so at this time, it started like over 6 months ago in the small cap technology sector. So one proxy, if you will, for small cap technology is ARK, like ARK Innovation Fund. So ARK Innovation Fund has also some healthcare in it, perhaps in like other components, but has a lot of small cap technology. And this is, okay, how poorly ARC Innovation Fund, ARC Technology Innovation Fund responded to the rise in interest rates. So it could be that like small cap technology kind of led some of the more recent a little bit decline in the bigger technology sector. And this is another really good chart on so again ARC, but this time kind of showing ARC, and correlation is not causation, of course, and I mean obviously not here, these are different time periods, but this is ARC versus the Nasdaq from 93 to 2003. So it's kind of a cool chart. I thought that it's kind of interesting to see that you know, like the, you know, perhaps somewhat a little bit comparable dynamic in those ones. So that's the Nasdaq before it's like super high peak and then co-ops, and like some of the recent co-ops in the small cap technology only. And that's tied somewhat to interest rates then as well. And so, okay, so mortgage rates spiked, right? So in real estate, we're like quite concerned about mortgage rates. We're interested in mortgage rates. So this is as of today, like where from few different, so Mortgage News Daily, MBA and Freddie Mac, like a few different sources. So this is the 30-year fixed mortgage rate. And so it already exceeded the 2018 levels, actually. And it's already, I think, like 5.6 and something like that, the average rate in the mortgage, 30-year mortgage rate in the market. Yeah, so why the mortgage rates rose? I mean, everybody kind of knows it, right? It's due to the rate hikes, but okay, so mortgage rates, as I mentioned, are driven by the 10-year treasury rate. So the 10-year treasury rate here you can see versus 30-year mortgage, fixed mortgage rate. So they move pretty closely together. The gap at sometimes, this kind of shows the spread between the two. So the gap at sometimes increases a little bit, but generally they move pretty closely together. And like I mentioned before, the 10-year rate is the biggest driver of mortgage rates. And because the 10-year rate has been responding to the rate hike expectations and pricing in some of those 325 basis points expected with varying probabilities for every date expected rate hikes by the Fed, and sort of it aggregates with all the probabilities, it aggregates to like some kind of level now. And so that's what the 10-year rate is responding to. And then respectively the market of mortgage-backed security that drives the 30-year mortgage rate is responding to that as well. And so that's another thing that is happening. Now to real estate investors, especially in the commercial space, like one of the most important variables is cap rate to interest rate spread. So this is a fairly recent chart from National Association of Realtors. So as of the first quarter of 2022, you can see the recent dip in the cap rate to interest rate spread across so apartment, industrial, and retail commercial real estate. So that is even before like some of the higher, you know, like some of the higher, more recent spike in interest rate after the end of March. So it's going to be interesting. In theory, it could get to zero as well, right? So, and if it did, then how does the value add the commercial real estate model work? Then it doesn't work much, right? So it gets pretty hard. So it's kind of a very interesting variable for commercial real estate investors. And this is the same cap rate to interest rate spread, but just a different chart that dates more back to 1990 and kind of shows in basis points the spread. And you can see how extremely healthy it was in 2020. So the healthiest cap rate to interest rate spread, like best time for, in a way, commercial real estate investors, you can say, was in 2011 and then in 2020. And so, and you can see it also in this chart in like around, well, 2011, 2012, and then 2020, like really high spread between cap rates and interest rates. And so that, but then as you can see, what we have on the second chart, okay, the super big spread in 2020, but on the first chart, then that spread just dipped through the current time and going further down. Because cap rates have been compressing, going down, but interest rates are going up. And so it's like puts tremendous pressure, perhaps shrinking the spread like several times, sort of multiple of times over a short period of time. So that's going to put the pressure on the value add like commercial real estate model, I suppose. And so, okay. And then another signal on the real estate market. So like I mentioned, just going over like a few like interesting charts that I have seen is the following. So this is, sorry, just 1 second. Yeah, so this is pending sales. And so you can, and then mortgage rates. So this was shared by Mitch Bollinger on LinkedIn. It's a good set of charts. So essentially, like as mortgage rates reduced ahead of like some of the so ahead of the global financial crisis, mortgage rates reduced, pending home sales really spiked. But then as we went into the the actual price decline of real estate, at the time, as indicated here, S&P Case Shore Index, for example, is the main index for US real estate. So then as that happened, then pending sales really heavily dropped. So that's like one of the things to watch for in terms of like real estate prices. Okay, are pending home sales declining perhaps, or what is happening? And so there is a little bit of that. And here, this second chart showed, the second chart is a little bit older, and it showed, well, a few months older perhaps, and it showed like sales over like forecasted sales kind of showing a decline, and then the current sales not yet. So there is a little bit of tendency of declining pending home sales, which is a little bit of a signal of real estate price decline or weakness in the real estate market. So again, those were like some charts, like just from finance and the general like interest rates and the recession. So again, like just kind of very quickly to recap. So we have like the yield curve inversion that happened last month. So around like, I think at the peak was maybe 6 or 7 basis points between the two, negative between the 2 and 10-year rate. And at some point, the 2-year rate exceeded the 30-year rate. So that's a recessionary signal. Like I mentioned, like generally very high probability of some kind of recession, can be a very small one within 24 months and even 12 months. And so this is like some of the chart that shows this. So we touched on consumer confidence as a signal as well. Again, even if yield curve inverts and let's say prices decline, then one could miss a huge upside afterwards. And this is one kind of illustration of that. Interest rates tend to drop in recessions, something to consider for most people super concerned on mortgage rates now. Sure, yeah, they keep rising in response to the rate hikes, but they will eventually, once rate hikes cease to work as a monetary instrument, then that's gonna perhaps kind of go down. And so, okay, so that was some of the discussion. So monetary policy versus interest rates kind of gap that is currently there, projected path for rate hikes. So the general kind of economic events that followed, like big spikes in interest rates, and so we are now like just above the, just above the 2018 level of the 10-year treasury rate. Volatility index not too high yet, and as mentioned, that ties to like market structure, at least in 2020, of volatility control in the stock market. And that market structure of volatility control, I do not see it exercising itself yet. And I kind of doubt it's going to be different just 2 years later. So that's something to watch for, that perhaps VIX ought to be higher if we're seeing something too significant in the stock market. And kind of a summary of different economic indicators: central bank liquidity and the tech sector, various other charts on the tech sector in the small cap and larger cap, mortgage rates, cap rate to interest rate spread. So those are again like some like general like economy, like interest rates, finance stuff. And yeah, do you guys have any questions before I move like to the real estate part?
Yeah. Stefan, this is Nelson. I got a quick question right here, and I'm following up what Siva said. I feel like I'm in a good review of my macroeconomics class in college, which I got to admit I did not pay that much attention to. It just seemed like it was out in space. Mm-hmm. And now that I got money on the game, I want to review every class, and I'm apologizing to every teacher, every professor. You said that interest rates go down during recessions?
And just Nelson, sorry to interrupt, and actually just to make sure on that first part, I can say I am too in a macroeconomic class, because it's actually, that's, like, do make sure to follow like some of these guys. I think, like I mentioned, let me show you on this slide. This guy is great, like Charles Henry Monshaw. Follow him on LinkedIn, Nelson. He has like really great charts. So some of the charts there actually I've seen from his content, and there are like a few others. So it's yeah, so just likewise very much in the same boat on that first part of today's lecture. And yeah, then we'll go to the real estate one. So
Okay, well, if that boat's a Titanic, you've definitely on the lifeboat. I'm still hoping to get on a life preserver or something. So Stefan, you mentioned that interest rates go down during a recession.
Yeah, I mean that's just the history. So that's just okay. If we take, let me just open. Sorry for kind of jumping through the slides, but yeah, that's just yeah. So if you look at this chart, so it has the Fed funds rate in this chart. Okay, 10-year U.S. Treasury. The gray bars are recessions. So you can see the significant rise in rates ahead of recessions, but then yeah, then it kind of goes down. And like I said, that was in 2020 when I was trading the interest rate market myself at work. It was at that time, it was actually, yeah, so it was actually, that's how we knew it's a recession, because there was a huge dip in interest rates. And that's something else that I showed on another slide. Sorry, right here, if you look at that huge dip right in the middle at the beginning of 2020, that's when like interest rate traders already knew, okay, that has to be a recession, just hasn't been detected yet or measured yet. So that's kind of,
I'm sorry, say again, please.
That's kind of the argument there. Just the history. I mean, you never know, of course, but that's just being generally the case, in the past. Just for people super concerned that interest rates are going to forever go because there's inflation. It's true because these projected rate hikes are responding to inflation. But again, like look at inflation in the 70s and the huge dip in inflation, huge dip in interest rates afterwards once we enter the recession. So it generally being the case. It's hard to say now, but that's kind of what we've seen. So that's my baseline scenario personally. So mortgage rates will rise more, in response to a 10-year rate, but then eventually will plummet super sharply down. And we just don't know the timing of that, let's say.
Okay. Because I just remember in the late, my goodness, I want to say it was the 90s, when you had interest rates that were in the double digits. But we weren't in a recession. So
yeah, that doesn't have to be. No, of course. Yeah, that doesn't have to be. I mean, I'm just saying that like a really sharp decline in interest rates, that's often correlated with a recession. That's all.
Okay, so it's an indicator. It's an indicator and a warning.
It's an indicator. It's some indicator. The bigger indicator is the yield curve inversion. So Nelson, so the bigger indicator is this thing that happened last month. That's what everybody responded to. And I don't know if you know, like some of those guys know, but like some of the real estate private equity funds, they started adjusting their strategy even and so forth. Very few. Most people are not responding much. But some are, and so they started a little bit adjusting. Okay, now what if there's some kind of.
And just to right quick, those real estate private equity funds, what was their adjustment of strategy?
Yes, I'm going to get to that. So I have a slide on that in the second part. So I'm going to get to that. If you let me actually on that part, I will get there, Nelson. I have that.
Okay. All right. Okay. All right. Stefan, thank you.
Thanks.
Okay.
So the second part, yeah. So like first part, like many charts from other people, and second part is kind of more like my own stuff. So second part is okay, focus on real estate. Yeah, Brian, you have a question?
Yeah. Thanks, Stefan. Question. So first off, do you have your like Series 7 license or whatever? Is that what you had before or no?
No, so I was like for 10 years a financial engineer, and I used to trade interest rate and equity derivatives. So that's the background there. So I don't view myself as an enormous expert on that part because I haven't invented, if you will. It's sort of see charts by other people. But the second real estate part, I sort of do view myself as an expert because I feel it's actually it's something I've been working on already for a few years.
Yeah. And so you mentioned the Eurozone there as well, and kind of saw what was going on there. How do you see the IMF and the United, I think it's the UN Bank, right? How do you see them responding in the future? As Jerome Powell just announced, there's more interest, basis points that are going to go up in the upcoming future.
Well, but why? So Brian, just confirm, why specifically the IMF? Like in what sense? you're interested in? Are you interested in like are you interested in other central banks like the European Central Bank, or are you interested in what they? Okay. Yeah, I'm not. I'm not knowledgeable on like their policy. Just you can see the current significant gap in monetary policy in Europe. So it's like super huge. So that's all I wanted to show it just for a second. We're not really touching on Europe here, though. I don't know anything about Europe at the current time, honestly. But it's just, just let me show it 1 second again. So that slide was, okay, this is the gap in COVID. Well, this is the 10-year treasury rate. So it's not exactly US monetary policy versus inflation, but somewhat, the 10-year versus inflation. But then this is the gap of, the short-term interest rates actually in Europe versus inflation. And so it's like a huge gap there. It's really strange, but the economy there is very depressed already. So they are limited in what they can do, sounds like. So they're not able to do like too much. It sounds like, so I don't know what that's going to produce. Like I said, I don't follow Europe. I don't really know anything. But in the US, it's, as you guys know, it's leading to this kind of rate hike path. And the reason only for sharing it here, that's the exact rate hike path that was priced few days ago by the futures market. So that's kind of, it's not like somebody making it up. It's more like, okay, that's what the market collectively is arriving at, something like that. So so that's why that's kind of, but again, like this rate hike path, what does it mean? Then the moment, if the economy starts going to a recession, then okay, the Fed stops hiking rates, and then it's just everything is gonna reverse, and that's been at least my thesis or what happened historically. So it's kind of hold on with your mortgage rate situation for a while, and then perhaps could see a reversal, but you don't know the timing, of course, so it could take time as well.
Absolutely. Okay, I appreciate the honesty, Stefan. Thanks.
Yeah, thanks, Brian. You guys have any other questions on this part before we go to the real estate stuff? No? Okay, so the second part, so this is like just general economy. So like the general, strong indicators on a recession, right? As we discussed, but that recession could be a very small one also, so we don't know, but some kind of recession indicated by consumer sentiment and yield curve inversion. And so now then the question is something that like I've been doing at my company, which is on the market side, which is measuring downside risk. So RealtyQuant, if you guys go to realtyquant.com, we have market valuations or real estate downside risk for 2,700 US counties. So that's another thing that I've been focusing on. So this was a little bit inspired by John Hussman from Hussman Investment Fund in finance, who has, this is like an article he did called Measuring the Bubble, where he showed like different metrics and how they correlate to subsequent S&P 500 stock market returns. And so you can see price earnings ratios having some, material correlation, but then like they have, at Hussman Investment Trust, they have defined their own metric, non-financial market cap, etc., that had, even higher correlation. So it's just like there are different ways that one can use to sort of try to measure if the market is overvalued. And so to do that, like just like a back study that I did was based on the global financial crisis declines. So these were the peak to bottom declines that took about 4 years and 1 quarter in different US states after the global financial crisis. So we have, let's say, the peak at the end of 2007, and then the median bottom was in the first quarter of 2012, actually. So over 4 years, kind of trickling down and like constantly going down until what I would argue is getting back to fundamentals, let's say. But those were like the declines then, and the big declines were in California, Nevada, Arizona, and Florida, of a magnitude of 41 to 56%. And then some other states, if you see, like for example, right in the middle, like North Dakota, South Dakota, Iowa, etc., they barely had a decline. They kind of dropped 3% and so forth. So the question, so what I was trying to understand is what drove that discrepancy. And so I was looking at like different variables at the time, like foreclosure rates. I was looking at volatility, risk-adjusted returns, and some other. And so here, this is based on, and so I kind of compute like simple fundamental analysis market valuations based on income, population, and housing supply. And for this presentation, like these numbers, they're just based on price and income time series. And so at the state level, correlation was like 83 to 87% versus the subsequent actual drops. So that means correlation of this map here. These are called market valuations. So market valuation is just kind of me coming up with the term of where the market is valued relative to its fundamentals at the peak, at the very peak in the global financial crisis, and then the declines that happened afterwards. So correlation between those two charts is 83 to 87%, depending on data source. And so then that's, you can see it by looking at the dark blue, California, Nevada, Arizona, Florida versus the big declines. And then you can see in the middle how undervalued the North Dakota, South Dakota, Nebraska, Iowa were, and they experienced very small declines. Another way to see this correlation is, let's say, this chart that I put together. So this is, again, you see the strong relationship between market valuation. And again, market valuation here is defined as deviation from fundamentals. Fundamentals are income, population, and housing supply. There is a way to proxy it by income only. And that's what I do for this chart here. But it's really income, population, housing supply. And so it's a very strong correlation. So undervalued states, they barely dropped after the global financial crisis. Very overvalued states, they dropped very much. And so, so that, and there are different approaches, again, like I mentioned. So this is, I did like several, and they're all simple linear approaches. I don't think there's need to do anything more complicated. And so two ratio-based approaches. So let's say current price income ratio versus 20-year moving average of price income ratios, high correlation at the state level. Kind of price income ratio normalized by housing shortage, if you will, where housing shortage is population to housing supply ratio. So also high correlation, and then some regression based models, again, with like prices versus income, housing supply, and population. So like different ways to do kind of this kind of study. But generally there is high fundamental analysis. Generally the thesis that I have is works in real estate. It's not like we touched before the stock market and the technology sector and so forth. It's much more complicated there. Okay, and then here, so county level, at the county level correlation is like 73 to 77%. So it drops around 10%. So it's harder to predict counties. And like I mentioned, I do have this data for 2,700 US counties at realtyquant.com. Okay, and then here is now the same thing, or let's say consideration of what market valuation is in different countries in real estate. And so Bloomberg Economics is one of the vendors who does this. And then there are a few others. There's a study at Florida Atlantic University. There's Local Market Monitor, where for you guys, whoever's a real estate investor here may know Neil Bawa, the data scientist. He uses Local Market Monitor for some of his market selection. And so, and then it's also, what else? There's Dallas Fed is another thing publishes like kind of different like real estate market valuation. So this Bloomberg Economics in 2019. So you can see in 2019 by price income ratio, at least like US real estate was like at 98.4, was like right, was like fairly valued. There was no overvaluation whatsoever. And then investors may have the narrative, they say, oh, real estate expensive and so on and so forth, but from a fundamental analysis perspective, it wasn't expensive at all. But in Canada and Sweden, New Zealand, Australia, and to some extent the United Kingdom was already actually fairly expensive, especially in Canada. It's quite interesting. It's been lasting for a while there. This overvaluation was already in 2019, pretty significant. And this is at the beginning of 2021. So beginning of 2021, US still fairly valued, still even under 100 in their study, in Bloomberg Economic study. At the beginning of 2021, but New Zealand, Canada, Sweden, Norway, very overvalued. And so that's quite interesting to see that US real estate is a different story from real estate in the other countries that actually they seem to have been in a bubble for a while, and US real estate seem to be among the better asset classes. Now that was until the beginning of 2021. And this again, this another chart I picked from LinkedIn showing the scans economies, if you will. So scans economies, they have like some similarities in terms of their open economies. They're somewhat like exposed to like commodity prices as well, and like some other aspects. And another thing they currently seem to share, though, their real estate is really overvalued. So that's Sweden, Canada, Australia, Norway, New Zealand. That's some of the most overvalued real estate right now. This is by OECD. So it's a different source, and it's showing, and that's showing some of the spike also more recently. Yeah. And so again, so like coming back to like the study that I mentioned before, which was, okay, this one for global financial crisis. So this is my own study, just to clarify. It went like over many like other charts by other people, but this is actually my own study. So again, if you guys have any questions, you can reach out to me or like, and so forth. So this is like the high correlation at the state and also to some also relatively high correlation at the county level between price declines after global financial crisis and the deviation from fundamentals in those regions. And so, yeah, so this study, again, how is it looking right now? It's very interesting. So I just updated recently the data as of year end 2021. It kind of tends to lag by a quarter and a little bit above a quarter. So year end 2021, that's how it looks. So 6 states to the west, you can say, Idaho, Nevada, Idaho, Arizona, Nevada, Utah, Colorado, and Washington, as well as 2 states to the south, Texas and Florida, are already above 20% overvalued. So it's not terrible in general. I'm not saying it's terrible, but it's not as bad as the GFC, but things have been accelerating. Maybe mortgage rates would now slow it down. It looks like it's not going to be so bad this time around. But still, that's kind of where it is now. And just to note, because you saw the previous chart or the previous information here from Bloomberg Economics that actually in the first quarter of 2021, US real estate was fairly valued. But then you're looking at this thing at the end of 2021, and then it's already looking like that. So that's quite interesting. So how did these numbers change so fast? It's not just a different source like between myself and Bloomberg, because it's actually was quite close to their like over market valuation then. So this is like some of the development. So for 4 years in like those, let's say 6 Western states, and here include a couple more, but like 6 Western states and 2 Southern states. So the trendy markets right now, if you hear like real estate investors, everybody tells to invest to the West and the South, right? That's where everybody is investing except California to the West. And so California is not in the list now because it's not overvalued now because there is no investor narrative for California. It's the reverse, right? And so, okay, so now it's relatively forward in the market cycle, that's how it's looking. So the range for 4 years, if we take Texas and Florida for 4 years, they were in the 7 to 10% range of valuation. So very slight overvaluation, COVID, like very healthy one for a very strong market. And then they kind of doubled, in the third quarter of 2020. So 2021 real estate changed, like US real estate changed, it was super fairly valued always. 2021 second, third quarter with inflation, with like people saying, okay, buy hard assets because hard assets do well in inflation and so forth. It also drives hard assets overvalued. And so that's like in the third quarter, how some of those numbers evolved. So an example is Idaho. So Idaho, already at the beginning of COVID, was actually Idaho was the Western state that led the rest states into overvaluation already at the beginning of 2020. So at the beginning of 2020, I was going to give some events and I was saying, okay, Idaho is already overvalued 25%, and it's the only one, but US real estate broadly is fairly valued. And so that was the narrative. So Idaho in 2020 still at 25%, and 2021 third quarter already 47%. And then fourth quarter 2021 51% for Idaho. And then if you look at, and then if you look again for, sorry, I just kind of went up. If you look again for some of the other ones like Arizona, so Arizona, just think about it like that. Arizona was 6 to 12% for 4 years. That's a very tight range, relatively tight range. By the third quarter of 2021, Arizona is already at 31%. And interesting. So 31 and 29, there's like a little bit of data adjustment. So it's right around 30. The exact number doesn't matter. 29 in the fourth quarter. And so, so it's kind of more of a correlation measure either way. And so that's kind of where Arizona got to. So it's quite interesting. So that's kind of a regime change, I think. Now, why this happened? So we had a discussion like about inflation. So this is to the right is real estate market valuation, the one that I compute. So that's how it evolved. For example, in 2001, like US real estate being slightly undervalued even, like, or fairly valued, and like 2002, perfectly fairly valued in 2002. And between 2002 and 2005, it went very overvalued. And 2005, 6, and then it kind of collapsed. And then at the bottom, it dips to undervalued levels, and then kind of comes up. And so now it has come up like the way like to the right. And it doesn't seem much, but it's also on a very short timeline. So if we go another year, we could reach the other one, but it looks like mortgage rates now responded very sharp. So maybe it's not going to get there. And it looks like it's probably going to be a milder kind of thing this time around. And also it could be not now or in the future. We don't know the time, right? But this is kind of like some of what drove it. Like, so the high spike in inflation, like drove, contrary to, I would say, like investors saying it's just good sort of to have inflation for assets. It's not just good. It's also drives your assets overvalued. And that's what market valuation is showing there. And so, yeah, so Nelson asked me about like that private equity fund study. So I'm keeping the source private, kind of not to like for their, sorry. But just one moment. Yeah, so that's it. That is a fund. So I did a lecture for them like several weeks ago, actually, and it's very interesting because they are one of the first, market participants in the real estate space that responded to some of the yield curve inversion and some of the other stuff, and most others are still buying stuff in Phoenix. And so that's, or some whoever's buying Phoenix or other Western and Southern markets, and that could be okay because they're going to do really well until it reaches the peak, but then that's going to carry certain downside risk. And so that's like their sort of adjustment to their acquisitions process that they share time on their investor list. So it's sort of reduced leverage, so 55 to 70%. Notice like invest in markets that are not heating up, and in their thing, it's Midwest secondary and tertiary markets. So if we go like back to the map, and I'll go to that in a bit, like Midwest real estate is actually high level speaking, Midwest region is fairly valued right now. But that private equity fund being very conservative and trying to not lose money for their investors, their selection is actually not even primary markets in the Midwest, but secondary and tertiary markets. But the odds of those dropping even in a broad-based decline in real estate are not very high. That's at least what I've seen in the data, and that's what we had after the global financial crisis. So lower leverage, investing not in Phoenix and Austin and Tampa, but investing in Midwest secondary and tertiary markets, longer term holds, and floating rate debt being hedged, and kind of using less bridge financing and like those kind of measures. Okay, so that's like we saw on the map, like some of the current overvalued. So we mentioned like the 6 Western states. I'm just kind of reminding that that's what I see. 6 Western states and 2 Southern states. So Florida and Texas are the place where big multifamily investors invest, right? So companies like Ashcroft Capital, we know with $2 billion under management, and other investment managers, those are the 2 big ones. They're already at 22% valuation positive. And then like some of the other Western states more overvalued. And here I have like a regression that is assuming like the same correction as global financial crisis. And it's showing what decline we could see if we have experienced a similar global financial crisis correction, which doesn't mean we will. And they will come like to a later point that actually there could be other scenarios. It doesn't have to be a correction, but just like something, it's an exposure to consider. And also there's no timing to it. And another thing very important to note, if a market is overvalued, this is not neither a bearish or bullish signal in terms of appreciation. Because valuation metrics are extremely poor predictors of appreciation. Like I did a study on that, was like around 12% correlation. So very slight positive correlation between valuation metrics and appreciation. So they're not a good predictor of appreciation. So sharing like high numbers for a market does not make me, for example, neither bullish or bearish for that market in terms of appreciation, but it does make me bearish in terms of their downside risk after the market cycle ends. And so those Western markets, they're through real estate being driven by momentum and autocorrelation, they're perhaps expected to appreciate like very, very, very much as they are now, and continue appreciating very much, very much, even if it's something like Idaho now, short of like some other triggers like mortgage rates, for example, now and so forth. But otherwise they would fall, if they would generally most of the time follow the general trend. And that can be measured by momentum indicators and autocorrelation. And so, okay, yeah, so those are those, and fairly valued states. So the most US states are fairly valued still until now. So most US states are fairly valued meaning between 0 and 10% valuation. So that's the full list. It's a big list. I couldn't fit, had to be put 2 tables because most are fairly valued. But the ones here, already 16 states are overvalued. And to clarify, in 2000, overvalued more than 10%. And to clarify, in 2020, it was less than 5, I think. So it has changed. So it was less than 5, but here it's already 16, and they kind of keep growing and adding more to the list every quarter. And so, but maybe that's going to reduce now with mortgage rates. Okay, so that's a fairly valued list, like most of the states, and very few, like 5 states that are pretty depressed, except North Dakota that is not depressed, and it's undervalued. And North Dakota was actually undervalued before global financial crisis and had a 0% drop in FHFA data. It's an extremely resilient state. It's quite strange. It actually keeps it's doing really well, 60% appreciation since its last fair valuation, which is above average performance. Okay, and it's nevertheless fairly valued again this market cycle, and it's again looks like not gonna drop actually much, you know. So because that was like the undervalued states then declined only about 4%, which was also the median income drop at the time. So anyway, so that's like another thing. And then market selection. Okay, so what is based on this is, well, you want to pick the best performing. No, you can pick anything you want because you can have any risk tolerance. So you can go in the Western markets too, because that's going to experience the highest appreciation. If you look at the rightmost column, the fair valuation to current price change, some of those states appreciation has been huge. So like really enormous appreciation. And so one can, you know, ride this appreciation more, but just simultaneously with that one will be carrying also the downside risk. Or another strategy is, okay, pick the best performing ones that are not overvalued. And those are some of them. And I'm not promoting anything for California. Nobody wants to go to a democratic state that kind of has like, you know, not very investor friendly policies, but just as an observation, due to this sentiment in the market right now, California is actually a top 10 performing state in appreciation. Well, but it is not overvalued. It is only at 7%. And all the Western states are overvalued with the narrative that they're cheap and California is expensive. California is expensive, Nevada is cheap in absolute terms. But in relative terms, Nevada is expensive, California is fairly valued. And so that's kind of quite interesting. So California actually in price appreciation has been extremely strong, but it's still fairly valued. It's actually at the top of the list. And then of course, all the investor considerations are there in terms of like its policies and so forth. But there is like South Dakota, Hawaii, Nebraska, North Dakota, Minnesota, Massachusetts, South Carolina, Indiana. Let's say Indiana is another like good example. Okay, perhaps a market to invest in right now that is, well, it's still relatively fairly valued, but it's has performed those relatively well. And these are like some of the drops that I mentioned that are just assuming like a post-GFC kind of correction scenario. So that's just a scenario. That doesn't mean, but if we were to experience, let's say, the same correction scenario, this kind of drops. So, and that's past an uncertain point in the future, right? And that, so then real estate market valuation in cities, like largest cities. So the study that I do, that is at my website, realityquant.com, is for 2,700 US counties. But this is kind of like the cities that are mapped to those counties. Now, I could get more precise. I could do a study at the city level or even zip code level and kind of spend a lot of time on it. But on the other hand, the predictive power is going to drop. So then the question is, we're trying to get kind of a market valuation. So if you put like super much labor to get a market valuation for a really small geography, is market valuation even meaningful for a very small geography? Maybe not. It's not so easy because your predictive power, when you test it statistically, how well it's predicting actual declines, it's going to drop. And so, okay, but this is for the general, a little bit more meaningful geographies, which are the counties that contain the different cities. And so Boise, Idaho is at the very top. Boise, Idaho. So Neil Bawa, again, like the data scientist in real estate, who he mentioned, so he was at this webinar actually in the fall. So he mentioned he has a substantial part of his portfolio in Idaho Falls. So he likes Idaho, and there are good reasons for that. Idaho has been the top performing state this market cycle, and the top performing city this market cycle is Boise. So Boise, you can see, is like 2.5 times the prices of 2011. And so yeah, Boise has been the very top performer. And so, but besides being the top performer, unfortunately happens to be or seems to be performing above its fundamentals. So it currently, it's a little hard to estimate. Some of the income data lags and so forth, but it currently seems to be like really, really high up there above everything else. And then Austin, Texas, Phoenix, like 36, 33%. So some overvaluation there. Fort Worth, Charlotte, North Carolina, Nashville, Las Vegas, Tampa, San Antonio. So those are some relatively overvalued places. And we went a little bit over time. I'm going to go a little bit faster at this part. And so then market valuations in the largest cities that are undervalued, actually. So undervalued, once again, it's not a good appreciation predictor. It poorly predicts appreciation, but it is a very good downside predictor. And so they tend to be, most of the time, they tend to be not very strong performing markets, as you can see by their price performance in the rightmost column. But there's, for example, Jersey City by New York City. So Jersey City seems to be at -4%. It actually, and it has performed like 54% price appreciation, which is fairly healthy, kind of average on a national level. It's not depressed in any way so far, unless it's showing like weakness for the future, but does not seem to be. And so Jersey City is undervalued, has performed well. And so are some cities in California, like Oakland, for example. And yeah, so those are like some undervalued cities, and then best performing, not overvalued. So we mentioned like, well, so that kind of I did this discussion. So I mentioned like Oakland, Long Beach, so cities in California. Boston is fairly valued at 2%, seems to be right now. It has performed really well this market cycle. And so, yeah, so they're like even Washington, DC, etc., and so forth. So these are like some of the cities that are not looking very overvalued. So cap rates and interest rates, they correlate positively. The correlation is around 65% there, depending on the period that you pick, let's say historically. And so, so this is kind of like the relationship. But the reason why I'm introducing this is the following. So if we have this study of like market valuations that is based on essentially deviation from fundamentals, but those fundamentals, they have income in there, and let's say we proxy it by price to income only. And so then we say US real estate valuation is based on price income ratios and then the 10-year treasury rate. And I've seen some of those charts relative to median household income, and I'm not sure what drives that, but relative to personal income, it's a fairly steady trade. So it seems it doesn't need to be adjusted. So there can be an argument, if interest rates were very low and now they kind of spike, perhaps we should adjust market valuation for different levels of interest rates. And one can do this. It's not too hard. It kind of complicates the model. And also, so this chart is showing, okay, it seems like one doesn't need to do it. And so with that, like we kind of went over like the real estate part, and just like to quickly recap it as well. So before we went over like the different like stock market like indicators, recession indicators, and the real estate part is really okay. Considering there is a little bit of timing or triggers or indicators from the stock market. In real estate, it's real estate investors, what are our downside risk predictors? And so this is like looking at like different measures on my end. Deviation from fundamentals or basic linear fundamental analysis seems to do the best, much better than volatility, risk-adjusted return studies, foreclosure rates even, and so forth are a very poor, leading foreclosure rates are a very poor predictor of downside past the peak. And so, yeah, so that seems to be deviation from fundamentals. Fundamentals is a good one. You see the very high correlation, for example, on this chart. Different approaches to actually do it, a bit lower correlation at the county level. How are market valuations according to Bloomberg looking in different countries? How they were in 2019, beginning of 2021, including after 2021 in the scans economies that seem to have the most overvalued real estate right now. And then current real estate valuation in the US that kept increasing every quarter, at least through year-end 2021. And so this, in 6 Western states and two Southern states generally being higher, and then the Midwest being fairly valued and Northeast being even undervalued to a big extent. And it's also undesired and not performing so well, but it's also undervalued. And so, so that's kind of something to consider. And so, yeah, so that's kind of like the regime change in 2021 that mentioned. Then some of the triggers of that are inflation is a big trigger. So you can see like the spike in inflation and the spike in market valuation. So inflation is not all that good. It's, you know, like real estate investors make it to be. And so that's like private equity fund that adjusted their strategies and like what are some of the over under fairly valued cities and states. And market valuation, well, seems like doesn't need to be adjusted for interest rates because well, interest rates have been on a 40-year downward trend, but market valuations in this framework that is used here were actually relatively flat. So that's like the lecture. So the second part of today's lecture, market valuations, you can find this data together with like appreciation forecasting, like short-term 1-year appreciation forecasting at realtyquant.com/analytics. If you want to get on my investor list, you can do that as well. And then once I get around to do it, I will be teaching a data-driven real estate investing course, kind of focusing more on the technology side. And I also have a YouTube channel. So you guys, some of you are on it, I'm sure, in terms of finance meets real estate on YouTube. So yeah, I can post the links. Just 1 second. Yeah, so do you guys have any questions? I think there may be a couple of questions on the chat, but okay, let me just type it. I know we went over time actually, but yeah. And then the YouTube channel, I just put it right at the beginning of this chat as well, if you guys want to sign up. So Sri, you had a comment actually on the chat. Do you wanna speak up actually to share what you mentioned?
Sure. I mean, the de facto step, if you look at the past history, the obvious de facto thing that Fed tries to follow is whenever there is a threat of a recession or recession is about to come, the only trick in their playbook is to reduce the interest rates, so encourage business to hire more people, start new businesses, take loans, SBA loans, what have you, and then start up. That's a good indicator every time, as you were mentioning in your chart. That's the purpose of doing it. I think somebody had asked the question, why would they actually decrease the interest rate during the recessionary period? That's the reason. I was just trying to explain why the intent behind that. Yeah, that's it.
Yeah, I mean, that's correct. I mean, rate hiking is generally somewhat bullish, one can say, but then at some point it stops, and yeah, it's quite tricky. But I mean, I just wanted to include like some more interesting charts. If you guys want to reach back like for the slides, I'm happy to share them. But yeah. Yeah, just 1 second. And again, if you want to see like more on the real estate market side, I would say, yeah, just make sure to go on like some of the links like at realtyquant.com. So that's pretty much.
Stefan, can you talk a little bit about what this data-driven real estate investing course actually entails? Like, let's suppose we enroll for the course.
Yes.
After the course is over, what is the real application in the real world for once you do that course?
Yeah, it's a good question. Yeah, so I haven't fully put it together yet. I have it posted for like a couple of months forward, and I keep shifting it and don't find the time. But that one is a little different. It has like a little bit of this market side, but that one focuses more on property analytics, and it's basically for people who are tech savvy, who want to use like Python and other stuff to find like to do like different scripts and ways for doing property analytics and discovering properties like that. So that's, for example,
can you give a use case for that?
Yeah, so a use case for that is, for example, if you have like on market or off market properties inventory, it's like to sort of do your own models for automated underwriting. So kind of to screen, it's more focused on finding deals. So kind of to screen properties, find deals, and yes, so automated underwriting has like some automated valuation models there, things like how you can do yourself something like the Zillow's estimate, how you can condition scoring also, condition scoring. So it has a little bit of machine learning. That one is basically a little bit kind of machine learning more property analytics. Also on the commercial, like for whoever is working into like syndication and commercial multifamily, it has some commercial multifamily off-market modeling.
Okay.
And so it's kind of very data-driven, automation-focused investor course.
So does the software actually pull data from the market, or do you have to provide the input data?
I mean, the software, it's more, that course is kind of teaching you how to do your own models, if you will.
Okay.
Yeah. So that's like, so it's just, let's say I just do it in Python, but that's one reason I'm not fully ready with that course. I'm working or open to like put like different like no code ways and like where one, because not everybody wants to like write Python scripts or knows how to write Python scripts, right? And so forth. So yeah, and it also, but another thing that teaches is also market analysis. Because market analysis, I feel like some of this part, if you look at like market valuation, it's so simple and people don't use it. And it's actually, so if you look at this second part of this lecture, you know, that's actually also useful. And it also has models for appreciation forecasting there in that course, like what's scheduled at least for it in terms of like, I know there are different models like Facebook profit and ETS, exponential triple smoothing, and whichever other different ways to like forecast price appreciation. You know, it works until the trend reverses and then it doesn't work as far as forecasting,
Sure.
right? But it's so this kind of, so basically all the data-driven things for people who are more relatively kind of analytically inclined, all the things are kind of in that course I've tried to put. So there's some machine learning, some market analysis, some like scripts for finding deals and so forth.
Great.
And modeling deals and that. Yeah.
Thank you. This was very informational.
Oh yeah, thanks as well. Yeah, so my email. So if you guys want to reach to me for the slides, this is my email. So stefan@trioticone.com. And the market valuations data, like I mentioned, you can also check my website for it. So we actually, since this stuff keeps changing every single quarter, so what we offer at trioticone.com is actually a lifetime, has like lifetime free updates. And so then you keep getting updated about that stuff like every single quarter because it does change. And so, or at least especially more recently, so some of these numbers are going to be different next quarter. And that. So yeah, do you guys have any other questions? Because I know we went like really over time, so I just want to make sure. Okay, so yeah, thanks for joining us here today. So yeah, this lecture is going to be on YouTube. Make sure to sign up to Finance Meets Real Estate on YouTube. And yeah, thanks for watching and have a good night.